Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
Chessman and David Gura here in the Bloomberg Interactive Broker Studio. We were just speaking about how Fed Chair Jerome Powell did say more good inflation data would still need to boost the Fed's confidence. But of course, we will get another update on CPI, David, here on Thursday. So traders looking at that. And I wrote a story earlier today looking at sort of the options market, what they were pricing in at the JP Morgan trading desk, seeing a potential move here of about 0.9%. So that actually would be the biggest in about a month, because just a month ago we had CPI and the Fed decision on the same day, but that is in line with the last three CPI prints. But we have two really great guests coming up to speak with us on this. So we'll also have Molly Smith, who's on our economics desk, but also Ira Jersey, who's at Bloomberg Intelligence headquarters in New Jersey, that's going to speak with us. But first, we're going to get a clip here, hearing a little bit more of what Fed Chair Jerome Powell had to say. So listen more of what he had to say about inflation as well as the path of interest rates.
The most recent inflation readings, however, have shown some modest further progress. And more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation.
All right, so that was obviously Fed Chair Jerome Powell on Capitol Hill, who will be speaking tomorrow as well in front of the House. So I want to bring in Ira Jersey, who here works at Bloomberg News, he's our U.S. interest rate strategist, and he's based actually at the Bloomberg Intelligence headquarters in New Jersey, as well as Molly Smith, who is one of our top editors here for the economics desk. I'll start with you, Molly, to kind of get a recap here of what people were expecting Fed Chair Powell to say versus what we ended up getting here.
Yeah, two very different things. I think people were obviously hoping to get a bit more about the timing of when we might be seeing some interest rate cuts, and Powell on two occasions said he will not be offering any signals on the timing of interest rate cuts, which I said to the chat, I guess we can all go home. Because it seems like that's really what we were all here for. And he then said again, when another lawmaker had pressed him on the topic, had also said, yeah, I'm not really going to get into that today. So bit of a bummer. So we're all still here sitting, okay, maybe one, maybe two.
Right.
TBD.
TBD. Ira Jersey, let me turn to you. That's the editor's perspective. Let me get the market strategy perspective on this as well. What were you listening for, and what did you hear from the Fed Chair today?
Well, first, let me say that Lori does a great job with the T-Live chats. So if you're, if you can't listen to radio or watch TV and you have a Bloomberg terminal, definitely hit up T-Live. Yeah, for sure. I participate, for example, and try to give my insights onto the rates market on those blogs as well. So I think from Jay Powell, like Lori said, he said even in his prepared remarks that they were going meeting to meeting. He tried to say we're as data dependent as we can possibly be, and he reiterated that. So he didn't say anything broadly new in terms of the monetary policy perspective, but the fact that he reiterated basically what was said in the June meeting minutes, which were released last Wednesday when the bond market was closed, at least, I think was just telling in and of itself, because it's pretty clear that they're trying to say, like, look, it might be September, it might be November, it might be December, but we're going to cut. The one thing that he did say that I think was important was he did reiterate that he didn't think that the next move as a hike was likely. And that's something that, remember, just 2 months ago, we were pricing for almost a 20% probability of a hike. That's almost being completely priced out of the market now.
Well, Molly, I want to bring you back into the conversation because David and I had mentioned we will get another update on CPI on Thursday. What are the expectations here from economists?
Yeah, so probably going to get something that's a bit more of a maybe inflation still gradually coming down. If anything, maybe moving still a little bit sideways in this range that it's been in. We've seen, which, Powell alluded to today, the big moves in inflation are past us, which, is to be expected at this point. There's less progress to be made, and it's going to be coming in, smaller chunks with each report that we get. So there was definitely a lot of questions on housing inflation today, and that there's, the best thing that Powell said that the Fed can do for the housing market is to get inflation back to 2%. So that will hopefully then bring, Treasury yields and interest rates back down, and then make, mortgage rates also more affordable. So that's really, to be expected from him. They can't really control, of course, that the U.S. has a persistent structural shortage of housing. And that's when he was saying, well, this is you on lawmakers to try to, that's more your job, and that's not something we can do.
No, we're going to get into that a little bit later in the show. But Molly, let me ask you about the crucible in which this is happening. So this is before the Senate Banking Committee. You had a pretty forceful statement from the chair of that committee, from Sherrod Brown, basically saying to the Fed chair, stop raising rates, bring rates down, that this is having a really deleterious effect on the American consumer, on those who want to buy houses. And there was also this kind of moment of emphasis on the chair's part about the independence of the Federal Reserve, as we see this kind of swirl of politics surrounding what might happen if Donald Trump were to be elected again. How did he deal with that? Sort of how did the setting of this kind of color your sense of what the Fed chair had to say?
Well, it seems like at least Powell and pretty much everyone on the Senate Banking Committee agrees that the Fed is and should remain an independent institution, and that there was pretty unanimous support on that front. And, without, of course, addressing the elephant in the room, that if Donald Trump were elected president, that's something that he's kind of looking to attack, right? That he, wants to be a bit more involved somehow in how the Fed sets monetary policy, and perhaps ousting Powell. This was someone who he appointed. So, clearly that there's a bit of, there's certainly a backdrop to all that, and I think he handled it pretty delicately, and just stressing, the Fed's credibility really relies on its independence.
Hey, Ira, I want to bring you back into the conversation. What are you seeing when we're talking about, say, speculative net positioning when you're looking at the bond market, and what that tells us about where traders are betting where rates could be headed in the second half of this year?
Well, a lot of the spec positioning right now is really basis trade. So it's people trading futures versus cash. There's a little tiny bit of money to be made. So in order to make that money, though, you have to lever yourself a lot. So that's one reason why you have such large shorts in some of the contracts. I want to go back to something that Molly said just a second ago, and that's about what Jay Powell and the Fed independence argument. Because from a market perspective, I think that if the Fed were to lose a significant amount of its independence, then you'd wind up in a situation where the bond market would probably sell off quite a bit, and certainly get a much steeper yield curve, because it'd be worries that the Fed would keep interest rates too low for too long in a future environment where you get more inflation. So I think that there is a risk there that something like that happens. And of course, way back when Jay Powell was first appointed, I was actually surprised that Donald Trump appointed him, because he appointed a mainstream kind of thinker from the Fed Board of Governors instead of someone more dovish. So Donald Trump will still have the opportunity to appoint a dovish Fed chair. He'll just have to wait 11 months to do that, and because that person won't take office till the beginning of 2026.
Molly, we've talked a lot about inflation, which is, of course, what we're all supposed to be talking about at this point in time. But we did get a little color from the Fed chair on the labor market as well. And I wonder what stood out to you from his comments. Of course, we have the rate now at 4.1%. But what did he say just sort of about his perspective, I guess the Fed's perspective on how healthy the jobs market is now?
Yeah, I think this is now starting to look a lot more like the jobs market that we had before the pandemic, which was a very healthy jobs market. And that Powell said something today that he hasn't really said yet, but has probably been true for a while, that the labor market is no longer inflationary. And that's something that, one economist, I noticed that he had sent around to his distribution list, that this has been the case for a while, but it's nice to see Powell finally acknowledging this, because there has been so much concern about, all of ththese job openings, and perhaps if that's propelling wages higher, or, what kind of inflationary environment that might get us into. But he seemed to be a bit more comfortable with where the labor market is in relation to inflation, but certainly that, like he's been saying, any unexpected weakening in the labor market could force the Fed to act a bit more aggressively.
Molly, great to speak with you. Thank you very much. That's Molly Smith from our econ team. Our thanks to Ira Jersey as well, our chief U.S. interest rate strategist at Bloomberg Intelligence, joining us from Bloomberg Intelligence headquarters just a bit south of here in New Jersey. And I know we want to get into some of what we were talking about, just sort of the knock-on effect of this kind of very strange economic environment.
That's right. And especially because why high rates have failed to dent record stock prices right now, as well as home prices too. So who better to bring in than Bloomberg's own personal finance reporter, Suzanne Woolley, who's here in the Bloomberg Interactive Broker Studio. Thanks so much for joining us this afternoon. And it's interesting because you wrote about how more people in the market right now, especially when you're thinking about stocks and what's happening with housing prices staying relatively high here, but it's still a confusing world of finance. And this is also what you wrote for her latest Bloomberg Businessweek story here. So walk us through this sort of dynamic, especially coming out of the pandemic, and how unique this is compared to history.
Yeah, well, for most of us, we went through such a long period of really rates near zero. You know, back in 2020, as early as 2022, though, they were at 0.08%. Now, this is the federal funds rate that I'm talking about. Now it's around 5.3%. So very abrupt ramp up. You know, there were like 11 Fed hikes in something like a 16-month period.
Right.
So came on big. And normally the script would be that we would expect the stock market to take a hit, and housing with mortgage rates now at 7%. In 2021 they were like around 3%. You expect that to take a hit. Hasn't happened, obviously. And a big reason with the stock market is, of course, AI.
Right.
It's just like powered over everything. And when you look at the S&P, Nvidia, it contributed like 30% of the index's gain to date. Microsoft contributed another 10%.
Right.
So AI is just sending it, a market cap index flying.
And even things beyond traditional tech and growth stocks, if you look at utilities, what people think it's more kind of steady dividend, low volatility. But if you have the particular sub-industry groups within it that are related to data center businesses, those have taken off at certain points this year too.
Exactly. It's like AI is, an energy play. It's such a huge energy guzzler. So those things have propped it up. And underneath, when you look under the hood at the S&P, I was just listening to Goldman Sachs' mid-year investment outlook, and one of their experts was talking about how, the average gain in the stock in the S&P for the year is like 3%. So beneath the breadth, as we know, is just so narrow in the Mag 7 or Mag whatever they are now, 6, 5.
Right, we've gone from a lot of different acronyms.
We're whittling it down. I want to ask you about the kind of consumer psychology aspect of this. There's such a great line in your piece about how, for most people under the age of 35, they never had to live in a world where rates are what they are. You talk about sort of what we've become accustomed to. How have you found, as you talk to people reporting out this piece, what counsel have they given people who might long for those lower rates, or not even know that they used to be as high as they are and higher still?
Right. Well, I mean, some people are saying, listen, these rates are really not that unusual when you look over the long scheme of things. So, people are thinking that rates. I mean, a lot of people think rates will go down. Now, people are saying with the Fed, maybe we'll get one cut in September and such. But you really have to sort of rethink some of your basics. There are a lot of people who have gotten into buy now, pay later loans.
Right.
Which we know so little about still.
Right, exactly. It's sort of a black box in a way. And we had a Harris poll done back in April that showed that 43% of people in those loans were behind in their payments. And that's an area where they're going to feel a lot of interest rate pressure. But also, just in buying a home, you have to sort of think through it a bit differently, because if you want to get a 7% mortgage rate, and rates don't go down that much, you really can't. I mean, it's not wise to take a flyer and just think, oh yeah, a year down the road I'll be down to whatever,
Do we see people taking more flexible rates or trying different types of mortgages, or are they just wedded to the notion that it's going to be high or where it is for
there are
a
little
while?
Pockets that are starting to pop up. Like there's something called, it's a little complicated, but it's an assumable mortgage. And it's when you can actually assume the seller's mortgage at their rate.
Interesting.
At their, it's complicated to do, but more startups are popping up to create a sort of a more organized market for these assumable mortgages, because it's so appealing. If you could just inherit someone's 3% mortgage, that would be great.
Right.
But it's very expensive because you have to sort of pay the premium on their home, and you have to pay off the equity that's in their mortgage. So you need a lot of cash.
Find the money for that.
Yeah,
Yes.
It's not a appealing option for for most people.
Well, we only have about 45 seconds left, but what do you think are the biggest takeaways for people to take from your story, as well as how long this dynamic can continue? Which obviously $1 million question.
Yeah. I think a lot of people that I spoke with, the more of the financial planner types, were just giving some good solid advice about diversification. And if you're sitting on some really big equity gains now, particularly in tech, they've been telling some of their clients, maybe do a little profit taking. Just make sure you're diversified. Yeah. Because there's just so much talk right now about expected greater volatility, how long can this last, which we've been hearing forever. But they're just kind of telling people to remember, if they need to rebalance, now they can get 5% on a bond.
Right. Well, that was Suzanne Woolley, personal finance reporter at Bloomberg News, on why high rates have failed to dent record stock prices and housing prices here. Thanks so much for joining us.
Suzanne. Thank you.
We'll have more coming up. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
And another really interesting story, David, that is in the terminal that we've been reading here is about looking at Bobby Jain's complex hedge fund debut and how it's spawning fans as well as doubters. So who better to come in than the author of this story, Hema Parmar, who's here at one of our hedge fund reporters at Bloomberg News in New York in studio with us. So walk us through your story here about Bobby Jain's fund. What makes it so complex such that it is unprecedented?
Yes. So what he's trying to do here is launch a fully formed multi-strategy hedge fund. That means it's going to trade 6 strategies on day one when it launched July 1st, trade all of those strategies, have the teams built out, have everyone hired in the right seats, all the operational infrastructure and back office teams. It's a pretty big undertaking. It's never been done before. Typically, hedge funds start out small with 1 or 2 strategies, and then they add on more over time. What he's doing here is birthing a fully formed multi-strat hedge fund.
Why is he going this route? So you described the complications of doing that. Yeah. He has been ambitious about what he hoped to raised a little less than I think what he wanted to at the very beginning here. But I think of a hedge fund starting in this environment in particular, how complicated that must be, how difficult it must be to line up the talent, the technology, infrastructure to do all of this.
Absolutely. It's very challenging in this fundraising environment too. His thinking is that it's more efficient. When you start a firm of this size doing these many different types of things, if you build the infrastructure from the ground up, ready for all the different parts, then you're less likely to have duplicate costs, duplicate talent. It's going to be more efficient. Every system will have everything it needs in order to get going, and you don't need to add on things later and then double over on expenses and everything. He also was trying to build a system where even if in the future he adds more talent and has more money to invest, that the costs of operating the business don't scale proportionally to that.
Talk to us more about the asset raising environment right now and some of the top challenges.
It's really tough out there to be raising money. So 5.3 is a good amount of change to be starting a hedge fund with. It's the second biggest launch that we've seen in years. It's the biggest launch we've seen this year. But the environment is tricky for a few reasons. Firstly, investors are not getting as much money back from private equity, from distributions as they have been in the past. And so that limits how much money they have to put to work. They're also a lot more cautious about every dollar they want to put to work. You have an option. You have optionality between the hot private credit markets or a multi-strat fund, and they've been somewhat underperforming recently. You're seeing a lot of questions over, should we even invest in hedge funds, or do we put it someplace else? With each dollar, do we want to take the day one risk in investing in a brand new manager and a new fund versus a tried and true option? So LPs are weighing all of these things, and every dollar is harder to get these days than it has been in some time.
The piece opens with a pitch at the seafood restaurant at the Breakers in South Florida. Bobby Jain making this overture to a Middle East sovereign wealth fund. I believe ultimately ponies up, I think, about close to $1 billion to the fund. How has he made that pitch? How is he trying to convince investors, yes, that this model that you've described as being kind of unorthodox is likely to work, and B, that this is the moment to do it. That, don't bide your time. Don't watch all of this unfold. Get in now, and this is likely to reap rewards here in the next, 12 months to 18 months.
Exactly. So he has gotten ADIA, which is the Abu Dhabi Investment Authority, with a $1 billion ticket. Other big name investors too, a number of bank platforms. So, his pitch is, yes, you get the ground, day one opportunity to invest in this fund. He's offered a lot of concessions, and his fees are cheaper. He's lowered fees. The bigger the tickets, the better fees you get for investing. He promised them future capacity. So if you're an investor, any future optionality, if you like what you see, you can get in later on, and that will be guaranteed. Some investors got co-invest opportunities. The liquidity of this fund means that you can get your cash back in 3 years versus other competitive firms are more like 5. Uh-huh. And there's a number of other investor-friendly terms. So you do see in this environment needing to have more concessions, make it worthwhile. And I think even Bobby Jain understands that there's a day one risk to doing this kind of thing, and made these perks advantageous for them.
And you talked about, obviously, the concerns and the caution that investors have. Clearly, there's different issues when it comes to lofty targets, but what are some of the underlying problems and the root of where those concerns lie?
With investing in hedge funds?
Right.
Yes. So, people use hedge funds in their portfolios in a few different ways. It could be to hedge against, if the markets take a downturn, then maybe you invest in some of the multi-strategy funds. Multi-strat funds aren't typically aiming to always beat the market. They want to be a steady return, roughly 1% a month, tried and reliable and true. And so that's sort of how they would think about it. But if you want, really huge returns, there are hedge funds that are incredibly volatile, where you can see double-digit gains one year and then double-digit losses the following year. So it really is like strategy dependent, fund dependent, liquidity dependent. As this strategy has shifted to become a lot more illiquid, the assets themselves are pretty liquid, but the structure of these vehicles means it's harder to get your money back, and it's become a lot more expensive to run these multi-strategy funds. There's been more caution when it comes to this specific strategy from investors, because they're thinking, well, do I want to be locked up for this long, and what am I paying for? Because they're paying for the talent and the compensation of these traders.
Your world is one in which I think personality matters, and the head of these funds are can really shape the way that the business works. I think Bobby Jain is as close to a household name as you can get. But what can you tell us about him? And is he in the mold of his Englander? Is he somebody who has taken a lot of inspiration from the time that he spent at Millennium? Sort of how does he operate? How is he as a manager? Sort of what's his personality like as somebody who's overseeing these billions of dollars?
Yes. So if you look at his tenure, he spent more than 20 years at Credit Suisse. He spent about 6 at Millennium. So really, experience at big name reputable firms. At Millennium, he was co-CIO, worked very closely with Izzy Englander. At Credit Suisse, he helped to build out various businesses. So he's sort of known for building businesses, working with teams, being sort of on that like higher up level versus being in the weeds on necessarily a trade. But he has been described to us as being more cerebral, more like a philosopher, thinks in matrices, and can jump between sort of the big picture idea and the in the weeds details. But we have also heard from investors that he struggles to communicate some of his ideas clearly and succinctly. And what that's meant is some investors have walked away from meetings feeling either frustrated that they didn't really understand things, or walked away with ideas of the firm that were not really what the firm is, or unclear as to what Bobby's trying to build here.
And Bobby trying to use that sort of seeing things as a matrix to oversee what I think he describes as a smorgasbord of options here at this fund. Just a fascinating piece by Hema Parmar on the Bloomberg terminal, Bobby Jain's complex hedge fund debut spawns fans and doubters. I was just fascinated by, I guess, the ambitions principally of doing this and trying to do it in such short order.
No, it's true. And then obviously the challenges that come with it and the money they've been able to pull off, but still the other issues they have to deal with.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
David, let's switch gears here and talk more about the latest jobs report data, as well as women leaving the U.S. workforce. We're going to bring in Laura Gassner Otting, a serial entrepreneur and HR veteran who's joining us on Zoom in New York City. Thanks so much, Laura, for making time for us. Now, we wanted to dig deeper here when it comes to this labor market report. Obviously, we get them monthly, but dig deeper to us. And when it comes to the issues, when it comes to women leaving the workforce, especially coming out of the pandemic and how that's been exacerbated by that issue.
I mean, I think that we saw during the pandemic, women were leaving the workforce in droves because obviously during the pandemic, our kids were all home from school. Suddenly we were dealing with our parents who were getting older, some of them getting sick. And women were the ones who had to pick up all of the slack. We saw women just absolutely leaving the workforce in historic numbers. But we're seeing that that's still happening. And that's due in large part because the gender pay gap, of course, continues. There's a lack of flexibility and control for women, especially as they become more senior. There's inadequate opportunities for advancement. It's hard to integrate work and life. And of course, we're all looking for more purpose in our life right now as well. So it's across so many different variables that we're seeing it. And because women are getting paid less than men for the same job, that gender pay gap does still exist. It just means that when it comes time to choose who's going to leave the workforce, it often ends up being the woman.
I look at just kind of the nature of the pandemic, which was without precedent, and how little time relatively has passed since then. And we do have this atmosphere now in a lot of workplaces where there is more flexibility baked in, able to work from home more. Do we know sort of how that's affecting workplace dynamics? Or again, given how little time has passed, are we still trying to figure out what the sort of longer term effects of that new, more novel flexibility is going to be on workers in the workforce?
Yeah, I think we're still trying to figure it out. And I think a lot of it comes down to the fact that, you know, the workers are using the same tools that they used in the office. They're using Zoom, they're using Slack, they're using all of the same tools that they're using when they're actually in the office to work from home. But the bosses, which tend to be predominantly male still, right? The majority of people in management positions are still men. Those bosses have to use different tools. So they can't just manage by walking around anymore. It becomes very different for them to figure out how they're going to see how people work. Now, I ran an executive search firm for 15 years, from 2002 to 2017. So 15 years. And we were always virtual. Like before it was COVID cool, we were all virtual. And people used to say to me, like, Laura, how do you judge the quality of your team's work? And I was like, are you waiting? Are you sitting? Are you listening? By the quality of my team's work. But the problem is a lot of bosses, if we can't see our people working, we wonder whether or not they're actually working. And so, you know, if you've got kids at home, again, you know, how old is the story of the man takes time off for work to go to the kid's soccer game? And everyone goes, oh, what a good dad he is. And the woman takes time off to go to the soccer game. And everyone's like, well, she prioritizes her kids over the work. So if there's a woman and she's in a flexible work arrangement and she's got kids at home, of course, we always fall to that age-old trope that it must be that she's being a mom and not working. So I think that bosses have to really change the way that they're thinking about how they manage their people and really think about what the metrics are by which they're managing their people. So it's not just, do I see them working? Okay, they must be working.
There was an interesting story in Forbes where they were citing a survey about how 60% of U.S. business executives said that their company will likely have to have layoffs over the next few months in the second half of this year. And that was based on a resume template survey. So if you are unexpectedly laid off, what high income skills do you think people really need and that will be crucial to move forward?
Oh, I think that we all have to, I think relationships, I think it all comes down to human capital all the time, always. So I could say AI, I could talk about, you know, all the different types of technology skills that we need. But at the end of the day, I think, especially now that we're all working remotely, being able to figure out how to create relationships, how do you steward a relationship, how do you decide what to ask for, when to ask for, how do you move that relationship forward? Business moves at the speed of relationships all the time. So making sure in this period of time where we're working in this remote, in this hybrid fashion, especially if you're a young person, making sure that you are making time to go into the office, getting to see people, going out to coffee with people, making sure that you are investing in that one-on-one relationship building time, because those are the skills that we're losing right now. They're sort of leaching out of our civil discourse. They're leaching out of the way that we work with each other. And so to be somebody who's able to create those high-level, deep, sticky relationships will be skills that will help people absolutely forever and ever.
All right, Laura, thanks for sticking with us. That's Laura Gassner Otting, serial entrepreneur and HR veteran who is joining us on Zoom here in New York City. And it's really fascinating, especially when you think about this dynamic of the labor market. Still, just at the end of last year, unemployment was still near a half-century low, David, and
Absolutely.
not far off from that still, even though it's around 4%.
And an interesting study I saw recently in the Harvard Business Review just indicating that this really kind of plays out differently among how senior you are within the workforce. So as I was kind of getting to there, I think there's a lot we still don't know yet just about how this is all going to shake out. This is Bloomberg Business Week on Bloomberg Radio. David Gura with Jess Menden in for Carol Masser and Tim Stenevec.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Jess Mitten and David Gura here in the Bloomberg Interactive Brokers Studio in, of course, for Carol and Tim, who both have the day off. If you look at where the S&P 500 is trading right now, David, though, we have a little under 20 minutes left to go, on track for its 36th record of the year.
It's pretty astonishing.
It is.
I must say.
I did a charticle after the first half, and at that point it had been 31 records. That was the best pace of records in the first half of the year, second best this century behind 2021. Obviously, that was when you saw a big rebound in the stock market from the depths of COVID. But we have so many different things coming up. Obviously, we have Fed Chair Jerome Powell, as we've mentioned, back on Capitol Hill tomorrow in front of the House. We also have that CPI report, of course, coming on Thursday, and then earnings season getting into full swing at the end of the week. Of course, the big banks like JP Morgan reporting, but who better to talk to us about his outlook on the stock market, the economy, all things, and Louis Navellier, founder and CIO at Navellier Associates, who's joining us once again. So it's always great having you back here with us. Talk to us about kind of your outlook moving forward, especially when we've continued to see a big rise here. And you're looking at the S&P 500, the spread between the S&P and its 200-day moving average hovering around 13%. But as you know, that can kind of go on for a while here, as we have seen the S&P 500 rise, Louis.
Well, earnings are supposed to be up 8.8% for the second quarter. That's the best estimate from the analysts in over 2 years. We have very easy year-over-year comparisons. But it should be, it's every stock for itself come earnings season. Now, the other thing is we're expecting a very good CPI and PPI later in the week. And so we might get a little turbo boost on the anticipation that the Fed will be cutting on September 18th.
Louis, as Jess mentioned a moment ago, the Fed chair was up on Capitol Hill, largely sticking to script as I saw it, as I heard it today. Anything stand out to you, and sort of how are you processing or thinking about what the Fed's next steps are here and how that's affecting your investment strategy at this point?
Well, the Fed's clearly worried about the labor market because we've gone from 3.4% unemployment to 4.1% in a little over a year. And so there's a problem. If we throw out government jobs and healthcare jobs, there's not a lot of job creation. And we have those negative ISM numbers. Manufacturing's been down for the last 20 months. There was 1 month when it went up, and now the service sector has been down 2 of the last 3 months. So anytime you get those ISM surveys under 50, it's a bad sign. So he clearly sees that they've engineered a soft landing, but they don't want to be too cute.
I've been taking a close look at systematic positioning as well as discretionary positioning. So obviously people listening, if usually fund managers have more of the discretion to make their changes, whereas with systematic positioning, it's more kind of tied to algos. But Louis, when I've been looking at that, especially from Deutsche Bank, it's interesting because they've seen a bit of, when you're thinking about sort of stretched positioning here for tech is what they're seeing, but they've been seeing that for a while, but they're also seeing more rotation into areas like financials and other areas that obviously have at times benefited from rate cut cycles there. How are you putting money to work right now in the stock market, and where are you putting that?
Well, I'm super concentrated. Most of our clients are taxable, and they don't like to pay a lot of taxes. So we are grossly overweight in Nvidia, Supermicro, another stock called ALAR, which is a cybersecurity stock. Also, we have CrowdStrike, another cybersecurity firm. But we're loaded with Lilly, Novo Nordisk, and those stocks right now are probably 35% of our portfolios. We have invested a lot in the utility grid and beefing up the demands for cloud computing. It's interesting. I'm here in Reno, and we have the Apple and Google servers here in Reno, but I live high in the hills in suburbia, and they have these they have diesel generators every mile to make sure it can meet our air conditioning demand. So because the server farms have priority around here, they can't go down, and so expanding the grid has become very problematic, and it's not easy. I mean, the power's just coming on now in Houston. I mean, people there have been kind of miserable for the last couple of days.
This is so fascinating to me. We had a big piece at Bloomberg last week kind of looking at this and the heightened demand that AI and cloud computing is having for energy and the consequences of building all of these data centers. Can you walk us through at a more granular level sort of what companies or what stocks are appealing to you as you look at, yes, NVIDIA, which you said is in your portfolio, with these others that are kind of secondary plays when it comes to AI?
It'd be Eaton, which is ETN, EMCOR, EME, Quanta Services, PWR, and then Vistra, which is VRT. Those all help make the grid more efficient and expand. The one thing holding the grid back is the Biden administration did pass a law that if you add a new, not a law, but an executive order, that if you do a new natural gas power plant, they would like you to sequester the carbon, and that's an 8-year permit. So normally you would just hook up a natural gas power plant and that's how you expand the grid, okay? But when you put all these new rules on it, it really messes things up. Now here in Nevada, we're next to California, we're extra green. Everything here is solar and batteries. We do have a lot of geothermal, but that can only do so much.
Since you are in Reno, talk to us about what it's like for the economy, what you're seeing consumers spending their money on, whether you're going to the grocery store or other things, telltale signs about the economy right now.
Well, Reno is a boom town because we're next to California and people move here. And, we got a lot of, the Schwab office in Reno is the largest in the world. So there's a lot of money hiding here. Plus we have a lot of corporate money. Microsoft is one of the largest employers in Reno because there's a 2% tax on gross revenue in Washington State. Amazon is here too, big time. So they're avoiding the state corporate taxes. But we have Apple, Google, Intel, the Intuit founders, my neighbor, Cisco's here. They're all we have a lot of treasury departments here. But yeah, we got a lot of wealthy retirees. The Californians come in and buy our real estate, and what used to be, 200 a foot for a home is now in the hills pushing 400 to 500 a foot. It's funny, the last 1,200 a foot, and then we have to remind them where they built. But it's a boom town. But we do have extreme weather here, and they should have a 4-wheel drive, and they better put snow tires on.
Right. We only have about 15 seconds left, but what's the top question you're getting from your clients right now?
Oh, it's all about the AI stocks, but fortunately we're loaded, so we're fine.
You're good. All right. Louis Navellier, thanks so much for joining us again. Founder and CIO at Navellier Associates, joining us from Reno, Nevada. We'll have more coming up. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.